Since the year 2000, American banks have collected $280 billion in overdraft fees, not from fraud, not from identity theft, not from some exotic financial product nobody warned you about, from checking accounts, regular checking accounts, the account your employer deposits into every 2 weeks, the thing your bank gave you when you were 22 years old and told you was just how this works. $280 billion since 2000. And look, a few years ago, a government agency actually tried to do something about it. The Consumer Financial Protection Bureau finalized a rule that would have capped overdraft fees at $5. $5, not 0.5. That rule was overturned by Congress and signed into law in 2025. It's dead. And overdraft revenue at major banks is rising again. So, that's where we are. Now, I know what kind of video you came here for. You've seen the trap videos. You know how the system works. You've probably watched 12 of them. And you're tired of being angry without a plan. This video is not another trap video. This is the exit, the actual mechanical set it up this Friday exit. Because here's what nobody in personal finance will say plainly. 2 in 3 workers say they live paycheck to paycheck, not because they're irresponsible, not because they eat too much avocado toast, because the container they were given, the default checking account, the one that came free with the bank's app, was designed to work for the bank, not for them. That's the thing we're fixing today. The container. And look, here's what I mean by that. When your paycheck hits, it goes into one account, one pool. And in that one pool, all of your money has all of its jobs at the same time. The rent money is in there. The grocery money is in there. The electric bill money is in there. The Saturday night money is in there. Every dollar is accessible to every purpose, at every moment, with zero separation between them. And the bank, Chase, Wells Fargo, Bank of America, whoever gave you that account, they love this because a higher average balance is more for them to lend out at 8, 10, 12%. More undifferentiated transactions means more merchant fees, and a single pool of money means maximum exposure to overdraft events, which, as we just established, they are collecting on very aggressively. Here's the number on that. The average checking account balance for a single earner runs around $3,000 to $5,000. The bank takes that money, lends it out at 8 to 10%, and pays you on a checking account somewhere between basically nothing and 0.39%. On a $4,000 average balance, they pull in $360 on your money. They hand you about $1.60. That's not a mistake in the math. That's the model. Now, the overdraft piece. 79% of all overdraft fees are paid by 9% of accounts, the people hitting 10 or more overdraft events a year. Median burden for that group, $380 annually. At 35 a pop, that's roughly 11 overdraft events, 1 a month. And here's what makes that so predictable. When all your money is in one undifferentiated pool, every transaction competes against every other transaction. The rent money and the restaurant money are the same money until one of them loses. The single pool is an overdraft revenue machine. And the actual fix is not behavioral, it's structural. I want to tell you something quickly, because it's relevant. I ran my whole financial life out of one checking account for years. Money came in, money disappeared. I'd get to day 18 of the pay cycle and start doing the math in my head, timing purchases around the deposit date, moving things around, watching the number. And I genuinely thought that I was just bad at this, that other people had some discipline I didn't have. The problem wasn't me. The problem was the container. And nobody told me the container was a design choice. So here's what you actually do. 3 accounts, that's the whole system. 3 accounts, 1 setup, 1 decision on payday, and then the structure runs itself. Let me walk you through each one. The first account is the bills account. This is a dedicated checking account. You can open it at your current bank in about 5 minutes, and its only job is fixed obligations, rent or mortgage, utilities, phone, internet, insurance, minimum debt payments. That's it. Auto pay everything from this account. The bills account is never touched for spending. It sits there, it handles obligations, and it is structurally separated from every discretionary dollar you own. The second account is the wealth account. And this one is the important one because this is where most people have failed before. And I want to explain exactly why, because it's not what you think. The wealth account needs to be at a completely separate institution, not a linked savings account at the same bank. A different bank, different app, different login. An online bank, Ally, Marcus by Goldman Sachs, SoFi, Axos, whatever you pick, it needs no linked debit card and no checking account at the same place. I'll explain why in a minute. First, let me finish the structure. And then the third account. Your original checking account, which becomes the operating account. This is your spending money. Groceries, gas, dining, entertainment. Whatever's left after bills and wealth are funded. This account's job is to be spent completely. By the end of the cycle, you following the logic here? Good. Because this next part is where it actually locks in. Now let's run the math, because this is where it clicks. Say you're pulling $45,000 a year gross. Federal taxes only, no state, no 401k, no health deductions. Your take-home is roughly $31.95 a month. Your real take-home will be lower. Adjust to your actual deposit number. But let's use this for the illustration. Payday hits. Before you see $1 in the operating account, 2 transfers go out automatically. The bills account gets funded first. Rent, let's say $1,100. Utilities, $200. Insurance, $150. Minimum debt payments, $200. Call it $1,650 total. That's about 52% of take-home, which sounds high, but these are obligations that exist whether you transfer the money or not. You're just moving them to a container that can't accidentally get spent. The wealth account gets funded second. Minimum 10% of take-home, that's $320 a month. This goes automatically on payday before you interact with the operating account at all. What's left? $31.95 minus $1,650 minus $320. That's $12.25. That is your operating account. That is your permission to live your life for the next 2 weeks without anxiety, without math, without timing purchases around the deposit date. Spend it on whatever you want. Completely. And if $45,000 isn't your number, let me give you the others, because this works at every income level, and I want you to see your actual number. Stay with me for a second. At $35,000 gross take-home, around $25.25 a month, federal only bills around $1,200, wealth accounts starting at $50. 50. That's 2%. Start there. Operating account, roughly $1,275. The wealth contribution is small, the structure is installed, and the structure is the point. Same math, just scaled down. Actually, let me be more precise. Same structure. The math shrinks, the system doesn't. At $55,000 take home, around $38.60, bills around $1,900, wealth account at $390, operating about $1,575. You see what's happening here? Same 3 buckets, just bigger numbers. At $65,000 take home, around $45.30, bills around $2,100, wealth account at $450, operating close to $2,000. Same system at every level. The percentages flex, the structure doesn't. Now, the operating account. I need you to hear this because it's the thing the whole system earns. The operating account is supposed to run to zero. Most people treat their checking account like a reservoir. You protect the balance. You watch the number. You feel anxious when it gets low. A low balance feels like failure. That instinct, that feeling, it's backwards. I know that sounds counterintuitive. It did to me too, for a long time. And it's causing you real harm because it means you're managing by stress instead of by structure. The operating account is not a reservoir. It is a spending account. Its entire job is to be spent. When it hits zero before the next paycheck, that is not a crisis. That is evidence that the system is functioning correctly. Because here's what it means when the operating account is at zero. The bills account is full. The wealth account is growing. The money you needed for obligations, it's there, untouched, in a dedicated container. The money you decided to invest in your future, it's sitting in Ally, earning 4%, completely inaccessible unless you make a deliberate multi-day effort to get it back. The operating account gave you permission to live your life, and you lived it. Zero is the destination, not the disaster. That's what never broke actually means. It doesn't mean you always have a cushion in checking. It means your obligations are covered and your wealth is protected, so running the operating account to zero is just Tuesday, Now, the wealth account, and why the separate institution is not optional. If you've tried automatic transfers before and reversed them, that's not a discipline failure. That's a friction failure. A linked savings account at the same bank has zero friction. 3 taps, same day, money back in checking. The reversal feels responsible in the moment. I need this, even when the urgency is temporary. Near zero friction means the savings account is functionally identical to checking. It's a place to park money between spending it. Here's the structural fix. A separate institution creates a 2 to 3 business day transfer time. And I know 2 to 3 days sounds like nothing. That's the point. There's no linked debit card. You have to log into a different app. And that delay, that inconvenience, is actually the protective feature. By the time the transfer from Ally clears back into your checking account, the urgency that felt like an emergency has usually cooled. I've done this. The urgency always cools. The delay is the protection. The friction is not a bug, it's the architecture. And here's a bonus nobody talks about. The online banks are paying 3.8 to 4.2% APY right now. Your bank's savings account is paying 0.39%, the national average. On $320 a month going into the wealth account in 1 year, that's roughly $71 more in interest at Ally versus your bank. Over 3 years building the emergency fund, about $630 more. Not a life-changing return, but the account pays you 10 times more while doing its actual job of being hard to access. All right, let's talk about the setup, because this is simpler than it sounds. The bills account first. Open a second checking account at your current bank. Label it Bills. Online, this takes about 5 minutes. Route all your autopay subscriptions and fixed obligations here. You don't need to close or change your existing checking account. Just add this one alongside it. The wealth account next. Go online to Ally, Marcus, SoFi, or Axos, any of the major online banks. All current rates are in the 3.8 to 4.2 range. Open a high-yield savings account. Do not open a checking account there. Do not request a debit card. You want a one-way door. Money goes in, money stays in. That's it. That's the whole account. Now calculate your split. Bills account. Add up every fixed monthly obligation. Wealth account. 10% of your take-home if you can swing it, 2% if you can't, but pick a number you can automate and not reverse. That part matters. Operating account. Whatever's left. Set up automatic transfers that trigger on payday. Both transfers go out before you wake up. The structure handles the decision. You interact only with the operating account. And then this is the last step, and it might be the hardest mentally spend the operating account. Not recklessly, just without guilt, without watching the number and panicking. The bills are covered. The wealth account is growing. The operating account is permission. Use it. Every 90 days, review the splits. Income changed, bills changed, wealth target changed, 15 minutes quarterly to keep the system calibrated. That's the ongoing maintenance. That's it. Now let me show you what the same paycheck looks like in 2 different containers. Same income, same expenses, 2 different outcomes. Person A, 1 checking account, $45,000 a year, good intentions, genuine effort, monitors spending, tries to save. Month 5. Reversed 2 automatic savings transfers when unexpected expenses came up. Paid 1 overdraft fee, $35 when a bill hit the account on the same day as a larger grocery run. End of month, $47 left in checking. Tried to build $320 in savings that month, saved 0. Person B, same income, same expenses. 3 accounts, setup done in 1 lunch break on a Tuesday. Month 5, operating account at 0 as designed. Bills paid automatically, never touched. $1,600 sitting in the Ally account, 0 overdraft fees. 0 savings transfers reversed, because reversing them requires logging into a different app and waiting 3 business days, and both times the urgency passed before the transfer cleared. Same income, different container. $1,600 versus 0, $35 in fees versus 0. The difference is infrastructure, not discipline. One more thing before we close, and I want to say this plainly, because most finance content will not. If your fixed obligations genuinely consume 100% of your income, if rent plus utilities plus phone plus debt payments plus food actually uses everything you earn, the 3-account system doesn't fix that. No system fixes poverty wages. If the math truly doesn't leave you any margin, the problem isn't your container. The problem is the income, and that's a different conversation. The system here is for anyone with any margin at all, even $50 a month, because the point of starting at 50 is not the 50. It's that the infrastructure is installed and running when the margin grows. And one thing coming that's worth flagging, right now the wealth account is a high-yield savings account. That's correct until the emergency fund is full. What happens after that is a different conversation. When you've got 3 to 6 months of expenses sitting in Ally and the question becomes where the next dollar goes, that math is coming. And when your income grows, when you get the raise, the promotion, the side income, the question isn't whether you can afford more. The question is which account gets the raise. The answer to that question determines whether you build wealth or just inflate your lifestyle. That math is coming too. Here's where we are right now. The checking account your bank handed you was designed to keep your money formless, undifferentiated, fully accessible to every purpose at every moment, earning them $360 a year on your balance while you earned $160. Think about that for a second. Generating overdraft events because nothing separated the rent from the restaurant. And the advice the financial industry gave you: budget better, be more disciplined, track every purchase. That advice requires willpower inside a container designed to defeat willpower every day. 300 transactions a month. The system always wins eventually. You just built a counter structure. Bills covered, locked in their own container, auto pay running without your intervention. Wealth locked behind friction at a separate institution, earning 10 times what your bank pays. Inaccessible unless you really mean it. Operating account spent completely, not because something went wrong, but because that's what it's for. You didn't get a raise. You didn't cut everything down to ramen and regret. You changed the container. Same money, different math. That's honestly it. Set it up this Friday.